Hello, Kevin.
You know.
There we go.
Yeah, it's not always easy across continents, is it? But there you go.
Yeah, Kevin, thank you very much for taking time out today to be with us. Appreciate it, everyone. Kevin works with Patrick Kareem, and they put together some real nice technical work. So, picture speaks 1,000 words. Kevin, if you want to share the screen, it's a green button there.
Yeah, I've got that. I think I'll just.
And Kevin's profession is a meteorologist, and before we get to some of the markets, these weather patterns. Do you believe that we've moved into this um, dry, cold? To be an ultimate contrarian, everyone's talking about global warming. I've interviewed some people that really believe that the opposite might be about to happen, that we could have another mini ice age like we had a few centuries ago, because of the lack of solar activity, and and also bear markets from climatologists that I've read or took into account what the sun did, um, do not happen during warm and wet type of situations, but happen more in cold and dry situations. Do you see that as a global trend? Or are you in the global warming camp, or neither?
That's a very difficult question to answer, Dale. Yeah,
When's the mini ice age coming?
there's a lot in there, but yeah, no, I mean, I treat my meteorology the same way I treat my chart trading, and just let the evidence
Right.
and the pieces of the jigsaw puzzle fall into place, and we can see quite clearly what's actually happening at the moment. We can measure sea level rise, and we can measure the mass of ice at the North Pole and the South Pole. So
yeah,
we can monitor all that kind of stuff. So I mean, my view is that for whatever reason, people have different views and opinions, but for whatever reason, the sea level is measurably rising by about 5 millimeters per year, and that's coming from melting ice. Again, for whatever reason, some might, so it's the same with the markets,
Just
so,
go ahead and share your screen, though, Kevin.
Yeah.
You haven't done that
Okay,
yet.
I'm just attempting to share the screen. I hit the share screen button, but I'm guessing you can't see that at the moment yet.
All right. So you still think the rise of sea levels, that we're in for this melt, and I know it's been awfully hot here on the west coast of. We're in a severe drought out west in the U.S.
Yeah, that's right. Well, much of the northern hemisphere is suffering from above average temperatures, and we've got heat waves going on across much of continental Europe at the moment that are breaking records. And I saw that across in the States, I think it was across in Death Valley, having some incredibly high temperatures even by their standards. So yeah, I'm hoping you can see the screen now. Is that visible?
I can.
Yeah, good.
Yeah.
Talking about long-term trends and climate and weather, we've got a very long-term chart here for silver. And,
that's a nice long-term chart. I just want to ask you, and then I'll stop interrupting you for a while. Does the action that we saw after the Fed last week change anything in the longer-term view? Or would we have to take out, say, $20 to kind of delay this parabolic move to the upside? And what great chart work you do, Kevin. Nice stuff. Good stuff.
It's always good to put things in context with a big picture, isn't it? So it helps you to realize that what the Fed might say from one meeting to the next is a lot of the time it's background noise, because the Fed are, they're trying to follow a narrative. They're trying to guide the markets. They're trying to perhaps give us the impression that everything is, doing great when everything really isn't doing great. And it's not the Fed's job to tell us when terrible things are likely to happen. It's the Fed's job to calm the markets and to try and help mitigate that. So you wouldn't expect the Fed to be able to actually admit what is likely to happen. Looking at these charts, it would cause market panic and all sorts of chaos, no doubt. So yeah, in terms of what what the Fed said last week.
To me, it wasn't what they said. It was how severe the reaction was from just jawboning, which kind of tells me there were a lot of weak hands and pretty fragile markets that would, or leaning really the wrong way. Many that we'd have that type of $2 break in silver and almost $100 in gold.
Which is why I think it's why the technical analysis really helps us, because from a technical chart perspective, it was all routine action really. There was nothing in there that was unusual or a problem or that broke any of the charts. So looking at silver here over a long period of time, of course, it's very clear that we can see a drop down to the second supporting arc is perfectly acceptable. That would be in the sort of $18 to $20 region if we came down, retested the edge of the second arc there. But the general trend over the next several years is clearly in an upwards direction. In the process of sharing that chart, it's just slightly knocked the lines out of place. You might notice one or two of the bits where the line goes outside of the second arc. That's just because it's slightly distorted it. But the target is clear. It's $100 plus in the mid to late 2020s. So from that point of view, it's all routine price action. I could show you just share this chart with you. So looking at it in a little bit more detail, this is gold's launch attempt, as I've been calling it, and you can see here that the arc, which has guided us all the way from 2011 all the way through the correction, it's been tested once, twice, three times, 4, 5, 6, 7, 8, 9, been tested on multiple occasions and has withstood the test. Perfect breakout and back test, typical chart action where you get break up through a downtrend line, bounced off the arc, above the moving average, 12-month moving average, and we've been correcting obviously since last summer, but we corrected back to a very significant point there, right on the edge of the arc. We took off, broke out of the pennant, and have come back down to retest the arc. So not at all unusual to see a retest after a breakout like that. It's bouncing off the arc at the moment. So we've got some very clear.
What price level is that? About 1740 on the arc?
The edge of the arc at the moment is around about 1740, 1745, that kind of number.
Okay, and if we take that out?
If we take that out, then the 1560 to 1830 zone of support, if you look across to the left-hand side of the arc there, you can see that price oscillated between 1560 and 1830 for a couple of years.
Oh, on the left-hand side.
On the left-hand side there, around about 2011 to 2013.
Yeah.
So from a chart symmetry perspective and also a support perspective, you would perhaps expect to see that if that was to be taken out, you'd see us oscillating for a couple of years between 1560 and 1830 before the upside move after the 8-year cycle low, which of course is coming up in either late 2023 or sometime in 2024. You can't pin these lows down precisely, of course, but every 8 years the precious metals markets take a dive, a bit like they did in 2008 and 2016.
Okay. So one of our attendees is saying that we could get this could form the cup of the handle of a cup and handle if we started trading in that zone.
It's a classic chart formation, of course, and the handle doesn't always form. It sometimes does, it sometimes doesn't, but you can get a messy handle forming or a very textbook handle. With the low being in 2023 or 2024, it would be a pretty large and extended handle for this type of cup, but it wouldn't be unusual at all. But it all hangs on just how transitory, in inverted commas, the inflation is that we're seeing at the moment. So inflation, as you know, has picked up from 4.2 to I think it's 5.5% in the United States now. So 5% inflation is perhaps a little bit of a problem when you're looking at rates on the 10-year yield and the 20-year yield, significantly below that, and real rates, of course, dropping in unison. So I can show you a yield chart. I just have to keep slightly minimizing the screen here because I've got a control bar at the top, which is quite annoying. There must be a way of taking that out of the way, but bear with me a moment. I'll just.
Yeah, I'm interested in everything you have to show. Okay, so
this is the Treasury yields.
Yeah. Okay.
So this is the yield on the 30-year note. So it's the longer end of the curve, the longer dated debt. I suppose relates to things like mortgages and that kind of thing that are related to US debt. But you can see quite clearly how
is this a 10-year yield?
This one here is a 30. Yeah.
Okay.
So it's the longer duration debt.
Okay.
So what you can see is since 2011, we've been building out a kind of a symmetrical triangle, I guess you'd call it, with the numbers in the blue boxes showing the US debt, not unfunded liabilities and all the rest of it, just the straightforward outstanding US debt mountain, which has quite steadily climbed by 1 or 2 trillion every few years, and then we've got a problem. We've got a problem because the chart's broken down, but we've got a problem because the debt has jumped in the space of a time period where you'd normally expect the debt burden to increase by 1 or 2 trillion. It's increased by 3 times that, 4 times that. So huge amounts of debt being added as a result of the COVID pandemic, of course. So why does that matter? Well, it matters because when you look at the 10-year note, this is the 10-year note here. We'll just minimize the pane on the right so you can see it better. So this is the shorter duration, perhaps more important debt, US government debt that is sold around the world. So investors will buy the 10-year note, and this is the rate of return they'll get from it. So going back to the late 1970s and early 1980s, big problem, very high inflation, high interest on the 10-year note was becoming an incredible problem. So Paul Volcker came along, whacked up interest rates, and that knocked it.
Were you in the business then, or is that a history lesson?
That's a history lesson. I was.
Don't rub it in.
I was born in '69, so I'm
the summer of love. Now I know how that happened. Okay.
I think my parents might have the answer to that.
Yeah, I'm sure they loved each other.
So ever since then, of course, we've been getting used to a rate of ever decreasing interest and of course attending sort of decreasing rates on the 10-year note. So that's all fine, but from a technical chart perspective, this is a descending wedge. It's slightly narrower at the base than it is at the top. And from a technical chart perspective, descending narrowing wedges are a bullish pattern. So it's wanting to break up the natural forces of chart action, the natural forces of physics, if you like, are wanting to break it out. You can see that happened back in 2018, and it wasn't allowed to continue for fairly obvious reasons. I think with yields of 3.35% on the amount of debt that was built up at that stage, it was clearly too much to handle, and the government stepped in, the Fed stepped in, bond buying, and managed to get the bond yields back down to the Treasury note yields back down to below sort of 2%, which is manageable. I'm not an economist, and I can't speak with authority about exactly what number is manageable and what isn't. But looking at the chart, it appears to me that at the time, somewhere just above 3% was a problem. Now, factor in the fact that we've doubled our debt since then.
And tripled the rates.
So there's going to be an issue here, because we've built out a bullish flag. It's a bull flag that's just formed here. If I zoom into the weekly chart, you'll be able to see that. And so the bull flag is a classic chart pattern which breaks to the upside. So what's going to happen here? Are the forces of nature going to be allowed to take over and the yields rise? And if they do rise to their natural target of somewhere around 3.5%, can the US economy deal with that? I don't think it can. I think the ability has fallen since 2018 for interest rates to rise much above about 2%, and probably a little bit below 2%. In fact, if you look at what's been going on with the real yields, you'll notice that although the yield has risen a little, the real yield hasn't, and the real yield has continued to sort of stay roughly where it is, or even fall a little. So that's, of course, as a result of inflation, background inflation at 5%. Don't forget. It's a problem, and so.
And you think we could have rising yields and rising gold?
Well, that's what I was about to move on to, because if you look at the 1970s, of course, and going back to that history lesson, I think we've become accustomed to the idea that rising yields are bad for gold, but it reaches a fundamental point, where rising yields, and I think it's a point of recognition, with investors and traders around the world, is that when there's a difference between rising yields that aren't a problem and rising yields that are an issue, and that has to do with the mathematics of the ability of
to service debt.
To service the debt, exactly. Yeah, and that's the problem we have now. So, in a nutshell, if the yields rise, gold and silver and the commodities generally will do well, because of the problem that's created by that. And if yield curve control is enacted, which is probably going to be necessary, then the real yield will fall away precipitously, and that's like throwing gasoline on the fire. At that point, it doesn't matter what the US dollar does. The US dollar can rise, and if yields are dropping like a rock, then gold will perform very well indeed. But if the dollar does turn down, and I've got a dollar chart here as well somewhere. Here we go.
Yeah, I'm looking for a rally back to 95. Okay, so we have an upside down arc here.
Yeah. So
okay, you have it at 93. Dixie.
So we have we have a topping pattern here, 1, 2, 3 touches and down.
Yeah.
We have this consolidation pattern ahead of it, and we've had a consolidation pattern here, topping pattern here, 1, 2, 3 and down. So far the arc, a bit like the other arcs that I've been following, has held very well. The upper limit of this arc is somewhere around about 93. It can spike higher, like it did at 0.3 here. It spiked up. So if we have other factors at play, we could see it move up to 94, 95. But it's the monthly close that matters. So it could spike up in July, but it's the monthly close that's going to matter. My targets are lower until or unless the arc proves to not be working anymore. So that's the technical chart analysis as I see it on the.
You do anything with stock indices, Kevin?
Yeah, so I've had a little look at the SPX recently. I can just bring that chart up for you. Hopefully it'll have remembered the chart that I did. So just adjust the chart so that it fits the lines I've drawn. Okay, so another very interesting point for the S&P, for the SPX, we're right at the limit there. So if we're seeing some kind of mania period, stock market blow off, then it wouldn't be at all uncommon to see a false breakout, as people sometimes call it, or a
throw over.
A throw over, yeah. I mean, this is a bearish rising wedge,
right?
Just like the one that we saw in Bitcoin several weeks ago. Bearish rising wedges, nearly not always, but nearly always resolve to the downside. The odds favour, like back here in 2009. We dropped out of that bearish rising wedge. So there are a couple of targets if we do drop down, and if we fail to break above approximately 4,300, then the targets are somewhere at 3,300 or slightly above, depending on the timing. And then the lower bound target is somewhere near or around 3,000.
Okay, that's my target.
Yeah. So a throw over top.
3,000.
Throw over top is possible, but just watch that sort of upper level there. And the same can be said for the other equity markets as well, of course.
One of our attendees is making a request to see your US dollar chart again.
Yeah, sure.
Ask and you shall receive. Paul landed. Kevin is, great guy. How do you like working with Patrick?
He's great. He really gets my my mind ticking. I have to start recording some of our conversations because he's a great one for going down rabbit holes and looking at things from a completely different point of view.
Were you guys surprised at all by the negative action in crypto? Do you guys cover
yes, of course, crypto. I haven't mentioned that, have I? Yeah. So the bearish.
There's your dollar chart, Paul. Take a picture.
There's the dollar chart. Yeah. So it's going back to the late 1980s. In fact, over there it's 1970s, isn't it? You can't really go back too much further, of course, because you start getting to the whole period where Bretton Woods, so it messes things up somewhat. But you have to base your charting on the evidence that we've got so far. And of course, the dollars. What I haven't got marked on here, of course, is the US dollar cycle. If I bring up my another dollar,
I think it's down for another couple years. Your 2023 number you mentioned, the year, I think 2023 for something was at that's a gold cycle for a peak in gold. I think you said.
Yeah, that's right. So the dollar cycle,
8-year cycle.
The 8-year cycle low in gold is around about 2023 to 2024. So this is completing the picture for the US dollar cycle. This chart here shows peak, base, peak, base, peak, and then the base, because the reason we're expecting it to reach a low point is the US dollar cycle, approximately 15 years, which bottoms out somewhere around about this sort of period in and around here, 2022, 3, that kind of period.
So they coincide with the gold cycle.
Well, the dollar low, the US dollar cycle low should be, as you can see here, there's one there in 2008.
23.
So let me just have a little look here. So 2016, when you get the high point in the US dollar, that should equate roughly to a low point in precious metals. So these points here, around about 2000, 2016, they equate to the low point in the precious metals cycle. So the highs on here equate to the lows in the US dollar in the precious metals cycle. The low point here is likely to occur, I suppose. Let me just work this out. Well, the high point should be around about 2028, 2030. So that's where we should see the high point in gold and silver and precious metals. It's going to be interesting to see what happens over the next few weeks and months, of course, with the US dollar. It's not behaving in the way that I perhaps would have expected it to.
I thought we were going to take out the January low too. Kevin, before the Fed acted, but W.D. Gant said, if you don't learn how to change your mind, you won't have any change left. That was convincing enough for me to not want to fade it yet.
No, not yet. And 88.25 is the number to watch, of course, and that's the low point here. So
that was 89.20 in January of this year that it couldn't even take out. At the beginning of the year.
No.
Okay.
So I was going to put a Bitcoin chart on, wasn't I? Just for a quick look. In fact, it's probably
you probably get from a lot of people that follow you a lot of questions of what's better, Bitcoin or gold, or Bitcoin or silver. What do you tell people? Both? Own them both?
I'd always advise people to sort of kind of have their investments spread across a number of markets. But it's timing, isn't it? You want to be kind of shifting your weight of holding.
These are like NFTs. Your charts are so beautiful that maybe someone will buy your digital technical art for a couple $1 million. Would you sell one of your charts for a few million?
Are you kidding?
What's your wire number? Anyway,
not much I won't do for a few million.
I don't even know what an NFT is anyway.
This is the Bitcoin chart, as I was posting it a little while back, of course. And if I go back a little bit further, prior to this action here, you'll see that we were charting on the website here that there was a bearish arc topping formation for Bitcoin, this inverted arc, and we also had a bear flag here. So the warning flags were there, the warning signs were there, and crossing down below the 100-day moving average was another warning sign, and finally breaking that flag, this channel. So
I called it the line of death.
Yeah,
that line there.
Yeah.
All right. So,
so at the moment,
Bronco? Yeah. What are you thinking here?
At the moment, it looks like this. So the bigger picture, we've got 3 arcs so far on Bitcoin. We're on to the third arc in Bitcoin's lifetime, and they've all completed very nicely, reaching the targets and then pulling back into the next arc. This is all cycle behavior, of course, that's dictating this. So you can say 2 things about Bitcoin from a charting point of view, using my charts anyway. Number one is that the price of Bitcoin has never ever been above this dotted line. It's never ever been above the resistance line. So that's a line in the sand. The other thing you can say is that the price of Bitcoin has never ever been below the arc. So arc number 2 and the one that went before it, arc number 1, the price has never been below it. So where we're at the moment is historic in terms of Bitcoin, because if we break down from here and we go down below 30,000 and have a monthly close below 30,000, then we're into new territory for Bitcoin. It's something that's never done before. Of course, this looks very much like a head and shoulders top. It's a wick-off distribution pattern.
But that would measure 0. It's a $30,000 formation. So if the breakdown at 30 would take it to 0.
It potentially could. I mean,
I don't know.
Well, from a technical chart perspective, it could return back to where it came from. I mean, with a lot of cryptocurrencies, and bearing in mind there are 10,000 or so of them out there. In this kind of environment, it's a little bit like the .com bubble. 90% of the startups,
the altcoins,
they'll disappear. They'll just go off in a puff of smoke, and they'll take everybody's investment with it. And there'll be a lot of people really, really hurt by this already, and even more so in the near future. We may get one more shot at it. Technically, from a chart perspective here, there is no reason, just from the chart point of view, not to expect it to complete and fulfill its charting destiny. But that would probably stagger a lot of people at this point in time. I think the sentiment is so bearish that everybody is now expecting Bitcoin to crumble away, Ethereum to fall below 1,000, and for a lot of the cryptocurrencies to just,
So the best way to follow you and your partner? If you want to show your website, Kevin?
This is where we are. We're on northstarbadcharts.com, northstarbadcharts.com, and we're both on Twitter. You just search Northstar or search Bad Charts.
Okay, well, Kevin, I really appreciate your work, and besides some of the forecasts that you make, you could tell about the effort and the care that you put into producing these, and want to thank you for your giving spirit to be here to edify our community today, my trading warrior brother.
That's great. Thank you, Dale. Good talking to you.
Yeah, great. Thank you so much, Kevin. My hope is that pips rain down on you and Patrick and all the people that work with you.
Thank you very much. Nice to talk to you.
All right. That's everyone. Kevin Wadsworth, and you can find him at North Star Charts along with Patrick Kareem at Bad Charts 1. And these guys are good. They're a must follow. And that's a wrap, everyone. Have a great day. We'll see you tomorrow. Remember, don't just count your cryptos, even though they're worth less, or your silver bars and silver dollars. Count your blessings. Adios, everyone. Thank you. Thank you, Laura. Everyone enjoyed you, Kevin. Adios.
Thanks, Dale. Bye-bye.
Take it easy, buddy.